Maybe we could talk about what is the exempt market,
Hmm.
alternative investments as they are known, but what differs them from the public market, which in most cases is publicly traded companies.
Yeah, so the public stuff, it's kind of interesting. The securities commissions, I mean, their number one thing is investor protection, and somewhere else there's like fair and efficient capital markets. But definitely they want to make sure that investors aren't buying something that they cannot easily understand, and they're not taking risks that are inordinate to whatever they might be purchasing. Again, main thing though is understanding. Their definition of that is it's an older one, and it's used in Canada as well as the US and many other jurisdictions. It's basically how much money do you have? Do you make $200,000 a year, 300,000 with your spouse? Do you have $1 million in financial assets, $5 million in net worth? And that's kind of how they say, okay, if you have that kind of income and that type of asset base, you're considered an accredited investor, and you can buy into these. And yeah, it's been used for quite a while. It's limited though to about 1.5% of the population of Canada. So that's the Ontario definition generally. I know there's different ones out west, like in BC. There's different exemptions under that, but it's like the hard and fast rule for the Ontario, and I think Quebec is you've got to have a fair bit of money behind you, which makes sense, like in a sense that if you lose this $30,000 or $100,000, okay, you can make it back in a year or so, or it's only 10% of your money. So what's the big deal? But the other side is that alternative investments can provide good, stable income, or be diversifiers, or have additional growth, which is the three things. You can have yield, you can have growth, you can have diversification. So if you're getting those things from these alternative investments, fantastic. Why wouldn't you have a lot of it? Everything else, like any sort of stocks, are going to correlate with other stocks. They're going to move up and down together. Even international stocks and bonds have been moving together in a few crises lately. It used to be stocks go down, bonds go up. Now, not so much. So now what do? Bonds are at historically low rates. There's a thing like if rates go up, you lose money in your bonds. It's mathematical. You cannot go against that. You're going to lose money in your bonds. And it's going to mature at whatever amount, but you're going to have a near-term drop in the price of your bond. So it is kind of weird that a lot of people don't have access to these. Now, we worked in the public market for about 6 years with mainly the Canadian Securities Administrators, the umbrella for all the securities commissions, to come up with the liquid alternatives. That's about $18-19 billion business now after 3 years. So out of the $1.5 trillion in mutual funds in Canada, it's a very small slice. But so that is giving some alternative for folks, but there's a lot more you can do there too. So
yes,
yeah, I'd like to have it. So I think registered reps like me, because we went through training at a broker and actually worked with clients and had to understand stuff, we probably do know enough to not be entirely dangerous. But I think there's other things like courses that people could take that would make sense versus having the income, because it's an easy measure, but it's probably not the most opportune or most apt in all cases.
Yeah.
My soapbox.
No, for